Hi friends. Myself, Puvana Rajan. I'm representing Group F for the finance presentation. Let me introduce my team. Myself, Puvana Rajan, Gauri Sudan, Anjali, Chandrakala, Maladi, and Iswaran. The aim of this paper is to analyze the performance of main group A and comment on its performance against company B. A fair comparison has been attempted over the performance of company A over the 3-year and competitor company B. This paper inclusive of clarification of ratio. What are the possibility reasons for the ratio performance and movement? Now, we will start the presentation with probability ratio by Mr. Gauri Sudan.
Hi all. I'm Gaur Sudan. I will continue with liquidity ratio. Liquidity ratio are financial indicators that evaluate a company's capacity to fulfill its short-term liability with its most readily available asset. These ratios are important for gauging a company's financial stability and operational effectiveness. For this ratio, I will be presenting current ratio and quick ratio. The current ratio serves as an indicator of a company's ability to meet short-term liability by comparing current liability, debts and payable to current asset, cash, inventory and receivable. Company A is better equipped to fulfill its short-term obligation. Additionally, financial stability is indicated. An upward trend implies the efficient management of both asset and liabilities. For company B, a current ratio greater than 3 implies that its possesses considerably more current asset compared to current liabilities, indicating a robust liquidity position. Secondly, the quick ratio measures the dollar amount of liquid assets available against the dollar amount of current liabilities of a company. The quick ratio, company A being below 1 of 3 consecutive years, indicates the company lacks sufficient liquid asset to cover its current liability, potentially signingly liquidity concern. Company B is quick ratio being higher signifies a robust liquidity stand, meaning the company possesses significantly more liquid asset than the current liabilities. Thank you. Next, I pass to Ms. Anjali.
Okay. Hi all. I'm Anjali. My part is profitability ratio. Profitability ratio can provide insight into how effectively a company management is running the business. Investor can utilize the ratio along with other analysis to assess whether company could be a worthwhile investment. I'm going to present gross profit margin, net profit margin, and operating profit margin today. Gross profit represents a company overall earning after subtracting costs associated with the conducting business. Particularly, it's a cost of the goods sold. Okay, and it's reported as a monetary amount. The gross profit margin for both company A and company B has decreased over the last 3 years, signaling a decline in the effectiveness of their production and sales process. This downturn may stem from several factors, such as increased cost of the goods sold, heightened competition. Secondly, operating profit margin. A company's operating margin often known as return on sales serves as the strong measure of the management effectiveness and efficiency in transforming sales into profit. The operating profit margin for company A and company B has decreased over the last 3 years, suggesting a reduction in the company operational effectiveness and profitability from their primary business function. Thirdly, net profit margin. The net profit margin is a valuable metric of assessing profitability as the components all aspects of a company operation. The net profit margin of company A and company B has declined over the last 3 years. Finally, a decrease is overall profitability in both companies. The metric represent the portion of revenue that remain as profit after all expenses. That's all for my part today. Thank you, and shall I pass the next presenter?
Thank you, Ms. Anjali. Hi, everyone. Myself, Chandrakara, and I will talk about solvency ratio today. Firstly, solvency ratio is one of several metrics used to assess a company for ability to maintain solvency over the long term. It serves as a thorough measure of solvency by evaluating a firm's actual cash flow rather than its net income, incorporating depreciations and other non-cash expenses to gauge the company's sustainability. Following that, this ratio analyzes cash flow capacity also in relation to all liabilities, not just short-term obligations. Now, I will be presenting two ratio, which is debt to equity ratio and interest coverage ratio. The debt to equity ratio assesses a company's total liabilities relative to its shareholders' equity and help evaluate how much it depends on debt financing. DE ratios differ by industry and are most effective when comparing similar companies or tracking a company's debt dependence over time. From these comparable companies, a higher DE ratio indicates greater risk. The debt to equity ratio for company A first declined from year 1 to year 2 and subsequently rose in year 3. In contrast, company B's ratio has constantly decreased throughout the 3 years period. A falling debt to equity ratio indicates that the company may be depending less on borrowed fund for its operations and growth, suggesting a more robust financial status and reduced financial risk. However, the coverage indicates how many times a business can fulfill its obligations using its earnings. A low ratio may indicate that the company faces significant debt expenses while having limited capital. The interest coverage ratio for Company A and Company B has declined over the past 3 years. For year 3, Company B's ratio was minus 3.9. A negative interest coverage ratio means that the company's earning before interest and tax (EBIT) falls short of its interest expenses. Thank you. Now I pass to Maladi.
Thank you. I'm Maladi here. Today we'll be presenting turnover ratio. Let's see what is turnover ratio. The turnover ratio is a financial indicator that evaluates how effectively a company utilizes its asset to produce sales and revenue. It is typically represented as a ratio of net sales to average total assets. This ratio aids in evaluating how well a company manages its assets. We have fixed assets turnover ratio, inventory turnover ratio, and account receivable turnover ratio. The fixed asset turnover ratio demonstrated improved performance from year 1 to year 2 for both companies, but then experienced a decline in year 3. Initially, the fixed asset turnover ratio exhibited enhancement, showing a more efficient use of fixed asset to generate revenue, but later suffered a drop, indicating possible inefficiencies. The inventory turnover ratio is a financial metric that indicates how frequently a company sells and replaces its inventory over a specific time frame. Companies A and B have shorter times to sell their inventories. In year 2, Company A took slightly longer to sell its inventory than in year 3, which is also the case for Company B. A favorable inventory turnover ratio indicates that a company effectively manages its inventory, frequently selling and replenishing it within a specific time frame. The receivable turnover ratio indicates the frequency with which a company collects its accounts receivable from customers within a specific time frame. The proportion between Company A and Company B has declined over the past 3 years. The accounts receivable turnover ratio has decreased, showing that the company is now collecting its receivable more quickly than it did previously. Thank you. Now I pass to Mr. Ishwaran.
Thank you, Ms. Maladi. It's me, Ishwaran here. Thank you, and it was an interesting presentation on ratio. My part is earnings ratio. The earnings ratio most commonly refers to the price to earnings ratio, which is a valuation metric that compares a company's price to its earnings per share. We have two ratios here, which are price to earnings ratio and earnings per share ratio. The earnings per share for the company has significantly decreased over the past 3 years, while Company A only saw a decline in year 3. The earnings per share ratio has fallen, suggesting a decrease in the company's profitability on a per share basis. This drop could stem from a decline in net income or a rise in the number of outstanding shares. The profit earnings ratio, referred to as the price to earnings ratio, assess the relationship between a company's current share price and its earnings per share. Investors utilize it to evaluate a stock's market value in relation to the company's earnings, offering an understanding of whether a stock is incorrectly priced or not. An elevated price to earnings ratio might imply that the market anticipates future expansion, whereas a lower price to earnings might suggest the stock is undervalued or that the company is facing challenges. Thank you, and I will pass to my colleague Puvana Rajan.
Hi, it's me again. We'll continue to of importance of non-financial information. Key factors to consider when evaluating non-financial information include metrics related to environment impact such as emission, waste management, resource efficient, record of safety and rate of workplace incident, status and history regulator compliance, rate of production capacity utilization, practice of source of raw material and reliance of supply chain, innovative of pipeline and adoption of technology, analysis of market position and competitive environment, quality of management, succession planning and strategy, stability of workforce and labor relationship, pattern of energy consumption and initiative for efficient. Now I pass to Mr. Gauri Sudan.
Yeah, okay. Hi. Let me continue on corporate governance. Corporate governance is essential for the suitability of companies in the metal sector, such as uh, such as Company A, Press Metal, and Company B, Chobi Metal. It established a framework for accountability, transparency, and ethical practice in the business. Here is a brief overview. Corporate governance refers to the system, rule, and processes by which a company is managed and supervised. Employee welfare, a human capital are essential elements that greatly influence the operational effectiveness of firms like Press Metal and Chobi Metal. Let's clarify. These concepts examine the parameters for assessing their impact on operational performance. Criteria, got two criteria there for the employee welfare. The first one, health and safety, ensuring a secure workplace and health-related benefit. The second one, work-life balance, flexible work schedules and leave options. Another one also got two criteria for the human capital. The first one, skill development, opportunities for training and professional growth. The last but not least, the second one, experience, level of proficiency and industry understanding. So that's all our Group F presentation for this corporate finance. Thank you, guys. Thank you.